Our home mortgage examples so far have all used fixed interest rates. What I want to do is look at one example with an ARM, an adjustable rate mortgage, where the rate may change. And I want to show you one of the things you have to watch out for with an adjustable rate mortgage. So we're going to use our last example to kind of work this out. So in the last example, we looked at a loan that was for $315,000 at a fixed APR of 4.65% for 30 years. Now the monthly payment we had worked out was $1,624.26. And after 5 years, we still owed $287,795.09. Now, a couple of reminders here. With a fixed rate mortgage, which is what we were working with before, the rate stays the same for the entire 30 years. And your monthly payment, therefore, stays the same because your monthly payment is reliant upon the 30 years and the rate that you had. With an adjustable rate mortgage, your rate may change, and if it changes, then your monthly payment will also change. And the monthly payment is basically going to be recalculated with the new percentage rate. So this is something that can adjust how much you have to pay to stay in your home every month. So let's look at an example of this. Let's say that you did have an adjustable rate mortgage instead of fixed rate mortgage in our last example, and that the rate stayed at 4.65% for the first years, but then due to inflation, the rate changed to 7.25% at the 5-year mark. Let's determine the new monthly payment you would have if you stay in the house instead of selling it. So what we're going to have to do is think about, to work this out, how much do we still owe on the house? Well, we had worked that out. We know that we still owe $287,795.09, and we have this new interest rate, and because we're 5 years in a loan, we have 25 years left. So we have 25 years left on the loan. So let's actually use the payment formula to recalculate what the bank would start to charge you if the interest rate changes to that 7.25. Well, payment, start with equals, then PMT, put the interest rate in. This new interest rate is 0.0725. We're still paying monthly, so that's divided by 12. Now we're paying 12 every month, so that's 12 months during the year for 25 years. And then we are, our new loan amount is really a loan amount partway through. Remember, at the 5-year mark it changed, so we look at how much we still owe at the 5-year mark. So that would be $287,795.09. Make sure you don't put a comma in that big number because the spreadsheet will misinterpret it. And then we want to again pay off to 0 at the end. So our future value is 0. When you throw that into your calculator, well, I should say spreadsheet, put that into sheets, what you will get is a new monthly payment of $2,080.20. So our new monthly payment is over $2,000. Let's compare that to where we were before. In the original loan, we were at $1,624.26. In our new loan, or in the new with the new interest rate, we're now paying $2,080. That's an increase of over $400 per month. That can be huge. If you have in your budget about $200 extra a month that you're putting into savings, if all of a sudden your mortgage payment jumps to $400, all of a sudden you don't have that $200 to put into savings, plus you're in debt by another $200. So this adjustable rate, because it can sometimes make your monthly payment go up, can be really devastating if that happens. It can make it from you having a monthly payment that is very affordable for you to something you cannot afford that's putting you into debt each month. So ARMs, or adjustable rate mortgages, are something you have to really be careful about, especially for loans that go for many years. Where people sometimes will be attracted to ARMs is when you look at loans that are short-term loans. Maybe you know you're only going to be in the house for 3 or 4 or 5 years. If that's the case, many organizations will lock in a particular low rate initially for a couple of years. So if you're locked into a lower rate before it changes to the higher rate, you may be just fine with an adjustable rate mortgage if you know you're going to get out of the loan within 5 years. But if you know you're going to go out for 30 years and you have a low rate to begin with, the chances are that rate may go up. And if it does, your monthly payment will go up. And that can be really hard to deal with. So watch out for that. Make sure when you're looking at home mortgages, you consider whether it's a fixed rate or an adjustable rate loan.